Welcome to another 8 Facts video. Today we will go through the top 8 most important facts about investing in the stock market according to ChatGPT. This list is a good introduction to some of the key principles and practices for investors to be aware of before entering the market. Before watching, make sure to like and subscribe for more content. Now, let's get into our list. 1. Research. It is important to research the stock market before investing, to ensure that you make the right decisions. Research is essential when it comes to maximizing stock market gains. It is important to understand the trends and the market conditions to make informed decisions. Research can help you identify potential stock market opportunities and reduce the risk of losses. While it can be useful to consult stock price charts in order to collect investment data, there are many other sources of information to consider. It is important to stay up to date on the latest news and developments in the stock market. Researching the companies you are interested in investing in can help you understand their business and financial performance. It is also important to research the stock market itself, to understand the different types of stocks and their historical performance. Sources such as publications, websites, and financial advisors can provide useful information to help you make the right decisions. Additionally, it is important to research the fees associated with different types of investments to ensure that you are getting the best deal. 2. Diversify. Diversifying your portfolio is a great way to minimize risk and maximize gains. This is an important part of investing in the stock market, being a risk management strategy that involves investing in a variety of assets to reduce the risk of losses. Diversifying your portfolio can help to minimize risk by spreading your investments across different asset classes, industries, sectors, and countries. This can help to reduce the impact of a downturn in one market or sector, and help to maximize gains over the long term. When diversifying your portfolio, it is important to consider the amount of risk you are willing to take on. Investing in different asset classes, such as stocks, bonds, and mutual funds, can help to spread the risk and reduce losses. Investing in different industries, sectors, and countries can also help to diversify your portfolio and reduce the risk of losses. It is important to remember that diversifying your portfolio does not guarantee profits, but it can help to reduce the risk of losses and increase the potential for gains. 3. Invest for the long term. Investing for the long term can help to reduce the risk of losses and increase profits. Long-term investments allow investors to ride out the market's volatility and increase their chances of earning returns. Long-term investments also give investors the opportunity to benefit from compounding, which is when the profits from one investment are reinvested and generate more profits. Investing for the long term also allows for greater diversification, which helps to reduce risk. Investing for the long term is beneficial in many ways, but it is important to consider the potential risks. Long-term investments are subject to market fluctuations, which means that there are no guarantees of returns. An example of a long-term investment being negatively impacted by market fluctuations is a portfolio of blue-chip stocks. If a portfolio is composed of blue-chip stocks, it is likely to deliver a steady return over the long term. However, the portfolio can be negatively impacted if the market undergoes a significant downturn. In addition, investors must be able to withstand the volatility and remain invested for the long term, which can be difficult. Therefore, it is important to research the stock market before investing and ensure that you are comfortable with the level of risk. 4. Monitor the market. Regularly monitoring the market and understanding the trends can help you make more informed decisions. By regularly keeping track of the market, you can gain insight into the types of stocks that are likely to perform well. For example, if you monitor the market, you may notice that certain sectors are outperforming others, and you can adjust your investments accordingly. In order to effectively monitor the stock market, it is important to use reliable sources of information. This includes news outlets, such as the Wall Street Journal, and financial websites, such as Yahoo Finance. Additionally, it is important to regularly review the financial statements of the companies you are investing in order to keep track of their performance. One example of a monitoring tool is the Stock Market Monitor from Finviz. This tool allows users to track the performance of stocks, indices, and ETFs in real time. It also provides detailed financial information about the stocks and ETFs, such as price, volume, and market capitalization. Additionally, the Stock Market Monitor offers news and analysis of the markets, giving investors an up-to-date overview of the markets. By monitoring the stock market regularly, you can make more informed decisions and increase your chances of making a profit. 5. Choose stable companies. Investing in stable companies can help to reduce the risk of losses and increase profits. Stable companies have a proven track record of success and often have a low risk profile. These companies are also more likely to have a history of steady dividends, which can help increase profits. Stable companies generally also have an established customer base, which can provide additional security for investors. Examples of stable companies include Microsoft, Apple, Intel, JP Morgan Chase, Coca-Cola, and Johnson & Johnson. These companies have a proven track record of success and have a history of steady dividend payments. Additionally, these companies have a large customer base, which helps to ensure their continued success. Furthermore, these companies have a wide range of products and services, which helps to protect them from sudden changes in the market. Finally, these companies are financially strong, with strong balance sheets and cash flows. Investing in stable companies can be a great way to reduce risk and increase profits. Investing in companies that have a proven track record of success can help to minimize losses and maximize gains. It is important to research the company before investing in order to ensure that it is a suitable investment. Additionally, it is important to monitor the company's performance and adjust your portfolio accordingly. 6. Limit your losses. Limiting your losses is important in order to maximize gains. It is important to set a maximum loss amount before investing, and to stick to it. If the stock drops to your set loss amount, then it is important to sell the stock and limit your losses. This will help you to protect your profits and maximize gains. It is also important to have an exit strategy. Your exit strategy should include a plan for when to sell the stock, as well as a plan for how to reinvest the profits. This will help you to stay disciplined and make more informed decisions. It is also important to remember to consider potential taxes when creating your exit strategy. The mental aspect of limiting losses is very important when it comes to stock market investing. It can be difficult to make the decision to sell a stock, especially if it has been performing well or if you have invested a lot of money into it. It is important to remember that it is better to take a loss and move on, than to hold on to the stock and risk losing more money. It is also important to maintain a positive mindset when investing in the stock market. Negative thinking can lead to poor investment decisions, so it is important to stay focused and optimistic. Being realistic and understanding the risks associated with investing can help to keep your mental outlook positive. It is also important to take the time to reflect on the decisions you make, and to learn from your mistakes. 7. Use a stop loss. A stop loss order is a great way to protect your profits and minimize losses when investing in the stock market. A stop loss order is an order to sell a security when it reaches a certain price. This ensures that you will not lose more than the predetermined amount. Using a stop loss order can be beneficial for investors who are looking to protect their profits. It can also be used as a risk management tool, as it limits your losses and prevents them from exceeding a certain amount. Furthermore, it can help to minimize the emotional impact of trading, as it sets boundaries in advance. In March 2020, when the coronavirus pandemic caused the stock market to crash, many investors used stop-loss orders to protect their investments. For example, an investor who owns shares in Apple Incorporated may have set a stop-loss order at $150, meaning that if the stock fell below that price, the order would be triggered and the shares would be sold automatically. By doing this, the investor was able to protect their investment from falling too far due to the market crash. 8. Invest regularly. Investing regularly can help to smooth out market fluctuations and maximize gains. Regular investing allows investors to take advantage of market downturns and buy low and sell high. This strategy has been shown to reduce risk and improve returns over the long term. According to Investopedia, dollar cost averaging, a form of regular investing, involves investing a fixed amount of money, at regular intervals and regardless of the share price. This helps to reduce the risk of investing too much in one stock, while also allowing investors to take advantage of market fluctuations and maximize their gains. Additionally, experts at the Financial Industry Regulatory Authority, FINRA, suggest that investors consider adding new money to their investments regularly and emphasize the importance of investing for the long term. Regular investing is a great way to limit risk and increase returns, and is a popular strategy among many successful investors. An example of regular investing working favorably for an investor is the case of Warren Buffett. Buffett is a renowned investor, and has made a fortune over the years using a variety of strategies, including regular investing. He is known for investing in stocks for the long term, and often makes use of dollar cost averaging to help him manage risk and maximize gains. He has often recommended this strategy to other investors, and it has certainly worked out in his favor. His long-term success is a testament to the power of regular investing, and he is a great example of how this strategy can be used to maximize profits. With fact number 8, we conclude our list of our top 8 most important facts about maximizing stock market returns according to ChatGPT. We thank you for watching and encourage you to check out our other videos. We also hope to get your thoughts on this AI program in the comments below. Remember to like and subscribe for more facts about a range of topics.